Welcome to the 12th edition of the Quantum Business Laws Symposium on Tax and Finance. We have noticed that over the last several months, there has been increasing requests for assistance for companies who are doing well despite the impact of COVID-19. Last week, we had discussed various different concepts on how to deal with protecting companies who have accumulated wealth. We also talked about ways that we could assist companies in order to achieve global expansion. That presentation was very well received by our audience, made up of mostly accountants and lawyers and business executives who have requested more information. Although we know the hardship that many companies have faced, and we know that hasn't been easy, and certainly a large part of our message has been to come to the aid of companies who need that sort of assistance. The other side of the spectrum are companies who are prospering in food services, transportation, certain areas of manufacturing, even construction. We've also found that companies are doing very well in green space, green industries, such as agri-industries, solar industries, in a number of different areas that have seen a huge increase, partly as a result of the economic and health crisis that we're facing. Today's webinar is going to be continuing to offer assistance to companies who are doing exceptionally well despite this issue, but it's also going to be offering assistance to companies who are seeking growth in their business. Therefore, we have three different parts to our program. The program itself will last 90 minutes. The first part will be dedicated to providing assistance to companies who are interested in growing, who are interested in entering into new marketplaces, new jurisdictions, globalization, if you will. The second part of our presentation will be dealing with how companies can achieve tax reduction and protect their assets in a time that has become critical, where uncertainty certainly looms everywhere. And also, we're going to be dealing with exit strategies, where entrepreneurs and successful businesses are interested in how they can position their affairs so that they can either go public with an IPO, they can sell the company, or perhaps they can pass it down to the next generation. So really, we're talking about growing the business, saving tax along the road, and then coming up with an exit strategy that can result in much more profit for shareholders. So without further ado, I'd like to introduce our expert panel, starting off with Lorne Saltman, who you've met before. Lorne, I'll have you just give a very brief idea of what you're intending to submit to the group today as far as some of the extra value that you think people need to hear about.
Just very briefly to everybody, I'm a tax lawyer, member of two law firms in effect. I'm the head of the tax group at Gardiner Roberts LLP, and I act as senior counsel to Quantum Business Law. And with the group today, I get involved in a lot of domestic and cross-border planning. And we're going to talk about how to position your company if you want to grow and eventually sell and maximize domestic opportunities commercially and from a tax point of view, but also if you want to expand abroad. What are some of the issues you need to consider, and how best can you position yourself to maximize the international opportunities within the context of Canada's international tax rules, which I will explain are some of the most generous in the world.
Thank you, Ron. Thank you. David Ayanoglou is well known in the M&A arena. David has been involved with some very large mergers and acquisitions. And David, I'll have you just give a brief summary of what you're intending to offer today to our audience, please.
Yeah, thank you, Todd. So my main discussion points will revolve around the non-tax portions of fueling growth. Good corporate governance, partnerships of a financing nature and partnerships of a non-financing nature as well. That's what I intend to talk about today.
Oh, that's great. Gordon Berger, I'd like to have you, please, if you could comment on what you intend to do. Of course, Gord is also an industry leader in the area of finance. He's also involved with estate planning. Gord, perhaps give us just some idea of what we hope to hear from you today.
So today I would like to share some of the experiences that I've had. I'm going to say pre-quantum and with quantum with Todd, working with Todd and Lorne and David. And we have a couple of other experts in bringing, bringing stories of truth to what we find when we start working with families and what happens after we finish. And they can go to sleep at night and say, yeah, I think I have everything done that I can have done. And there are major problems in this pandemic, and people aren't recognizing them because nobody's bringing the issues to bear other than unemployment, etc. So we're going to talk about a lot of these things as well.
Oh, thank you. And I think most of you have seen me on this program before or in live venues, but nonetheless, I'm going to be trying to address some of the comments and concerns that I've heard from some of the members in the audience over a period of time. And previously I mentioned that we're having an increasing number of inquiries about how companies can grow. Companies that have gone through this hyper growth phase and really don't necessarily have the financial capability to continue with some of the things that they'd like to achieve. So we're talking about accessing global markets. We're talking about achieving sustainable growth. And one of the biggest roadblocks that companies face is lack of proper financing. The banks seem to be very concerned about advancing money to these kinds of companies for a number of reasons, but the foremost, I think, is the economic uncertainty that we're faced with. And oftentimes we hear that companies just simply can't seem to find the funding that they want, whether it's to exploit technologies, develop intellectual property, or just simply to bring their products on the global scene. That being said, I'd like to talk a little bit about some opportunities that might exist for companies in that situation. So one of the things that we've been doing is we have been working with companies who have benefited from various different types of financing. And one of the financing types that I'll refer to involves the issuance of bonds, either the issuance of bonds on a bond market or the issuance of bonds otherwise to financial institutions on the basis where money is raised, which is later lent to these companies. And one of the reasons why this tends to work is because of the fact that in Europe we have negative interest rates. Bond yields are negligible. So if a company can make a 1 or 2% yield on a bond, it's considered very attractive and they're all over it, which means that it allows for companies here in Canada and internationally to be able to receive financing somewhere in the 3% range, oftentimes, for a period that's guaranteed for as long as 10 and perhaps even 15 years, which would correspond to a bond offering, which is created for that kind of a company. So this is non-traditional financing that many companies have benefited from. And there's much more to talk about, but I think what we should do is we should talk a little bit about the kinds of issues that companies need to be thinking about if they're intending to take a leap, intending to globalize, and would like to be in a position where they can be well received by suitors that have the funds, that have the capability to be able to move these companies forward. David, I'd like to ask you to talk about 2 or 3, 4 different things that oftentimes companies would do well to consider in order to be perceived in a favorable light from the kinds of financing opportunities I'm referring to.
Yeah, so I guess the one thing that I want to talk about is good corporate governance. And corporate governance has been something that's received spotlight, especially after major scandals, after Enron, for example. corporate governance, or good corporate governance, came into the limelight a lot more than it's been in the past. Really, those types of scandals have prompted regulators from all over the world to implement various acts and rules to rein in irresponsible corporate behavior that mar the prospects of corporations and cause harm to their stakeholders, and so on and so forth. So good corporate governance is the art of directing and controlling an organization by balancing the various needs of stakeholders through disclosure, transparency, policies, and the like. And they protect both the general public, their investors of the financial nature. Their customers also would like to see good corporate governance, as well as their suppliers of a given company like to see good corporate governance, because that speaks to the longevity of their business. And once they have good corporate governance, it puts them in a good position to fuel growth. And good corporate governance also is not just does not speak to the management team only. It also speaks to the board of directors. And over the last, I'm going to say, decade or decade and a half, 2 decades, it's become increasingly important that a company that wants to fuel itself for growth have a strong board of directors. It'll provide them access to things that they wouldn't have as a management team, because a good, strong board of directors has titans of industry, has titans of business that allow the business to grow in a way that the management team, maybe being in the weeds, is not able to see and govern in that direction. Also, a good board of directors, through a good chair of audit committees and other committees on the board, keeps a good handle and control over the reporting and other aspects of the business that are, I think, vitally important to set the stage for a large growth. Other things that companies might want to consider is partnerships, and I'm talking about partnerships beyond financing, whether they be reseller arrangements in certain geographical and jurisdictions throughout the globe.
David, how would you describe what a financier would be looking for that would be, interested in offering assistance for companies to globalize? Now, I'm talking now about what would they be looking for in a good board of directors? What kinds of skill, what kinds of background, what are the main concerns when looking at companies to ensure they're the right fit to qualify for the funding?
Yeah, they would be looking for independence.
Oh, why?
Yeah, they would be looking for independence. They would be looking for titans of industry. They would be looking for execution experience. And they would also be looking for controls experience. Those are the things that an investor would like to see.
So what happens when you see a company that has great ideas, they do not have execution experience? The scalability is a concern. They've developed wonderful intellectual property, but they just don't have the team. What do you think companies like that could do?
They need to acquire the execution experience. Oftentimes, we oftentimes see companies with great ideas that go nowhere, only because they don't have the execution experience. So getting that on one's board, getting that on one's management team, very important.
What about venturing into various different geographies, David? What advice would you give to companies who are considering, say, operating in various different countries, Europe, Africa, Asia? Yeah. What would your advice be?
Yeah, that's where kind of where I was going before. Partnerships beyond financing. So there's reseller arrangements that one should consider both in his home geography and external geographies. And it depends on the type of relationship that a business wants to hold with its customers. And so that's a larger discussion, not for today, but one ought to think about resale arrangements. When one is considering expanding a business into different jurisdictions, oftentimes there's local nuances that would be well serving to the company to have local experience on. For example, Switzerland has cantons that, Lauren, you could talk about the tax impacts of various cantons and the tax structuring, but it also has implications at the business level. South Africa, for example, requires you to have be part of the BEE program, which is the Black share ownership of a business. Dubai has a similar infrastructure in place where it requires a local Dubai resident to be part of your corporation. So there's all these local isms that one should consider, and when one's looking to go in a given jurisdiction, they would be well served to have a local expert.
Let's move into the issues of the financial aspects. So what are the financing partners really looking for from a financial point of view? Let's talk about balance sheets. Let's talk about other issues that are of concern.
Yeah, so they're looking for collateralization on the balance sheet. They're looking for debt service on the P&L. They're looking for growth and scalability. But most importantly, they're looking for sustainability. So I would say those are the top 3 or 4 things from a financial perspective that a financier would look for. And I would say specific to financing, it's of utter importance that you find the right financier, right financial partner to help you fuel the growth of your business. And we talked about debt being a tool for financing, but there's also equity, there's mezzanine financing, and each and every type of financing has its own pros and cons, right? So, and some of those pros and cons play out in the sale process, whereas other pros and cons play out in the daily management of the business, especially as it relates to mezzanine financing, where lenders convert and partake in financing. And one point of discussion that we can open up to the whole panel actually is setting up super voting shares for existing shareholders or the family of a business so that they can retain power, voting power in a corporation. And I'm going to put that out to the whole panel to get their thoughts on that.
Yeah, let's kick that off because voting control is an interesting question. Sometimes in an effort to achieve voting control of a company, there is shares that are issued that don't necessarily have a liquidation value. And oftentimes those shares can be issued for a number of different reasons. David, you're mentioning the use of voting shares in the context of being able to maintain control of a company in light of incoming financiers. Other instances could be that there might be a very good reason why we don't want that individual to necessarily have voting control in order to achieve, status as a non-Canadian controlled company. So there's a whole bunch of issues. Perhaps, Lorne, you would have an idea on, let's hear your input on this whole notion of ensuring voting control by an entrepreneur in light of incoming financiers.
I would distinguish between 2 different spheres. I think super voting shares in terms of an estate freeze for the family's benefit makes a lot of sense. Because what you're really doing is setting yourself up for pushing the growth to, let's say, a family trust for the benefit of the family. I'm not sure in the commercial context that it's as desirable or effective to put out to a founder of a company the opportunity to continue to retain control through having super voting shares, yet bring in a significant lender/investor. I'll give an example that I found some time ago. This was a potentially very large project, and I was working with 2 scientists who had created an innovative product with a manufacturer that could produce a new product on a scalable basis. This was a great opportunity, but it required a huge amount of financing. And I spoke with some industry leaders and investment bankers. We ended up going to a couple of Canada's very large pension funds because this was going to be an infrastructure opportunity that they were interested in. And the founders wanted to retain control, but they were told by the investment banker and by the pension funds, no way. We're the money, and you're going to have to be diluted down significantly. And you can't retain control. You can manage, but not in terms of the ownership of the shares. So while in theory, a founder can attempt to retain control, I think in reality it's going to be very difficult if the founders are really looking for outside money, particularly in early stage growth companies where there isn't a lot of bargaining power in the hands of the founders. Financially, there is obviously in terms of their technology and so on, but looking at the economics, I'm not enthusiastic about the idea in a commercial context as opposed to within an estate freeze for a family.
I think, Lorne, we're in agreement with each other, especially I've especially seen it work for later stage companies that are established, that are looking to go public. So they're not dealing with a given financier. They're looking to IPO, for example, or to do a second public offering. And so they issue preferred shares to the family with super voting shares where they dilute their ownership, but they retain the voting rights. And that's, I think, the instance where it might work.
Like a Magna type of arrangement.
Yep.
Yeah.
Can I
there are lots of examples in the public sphere of that.
Yeah. David, you had mentioned about going public and utilizing that strategy in order to insert control for the family. That makes a lot of sense. Why don't we extend that a little bit further and talk about companies who are interested in going public? When should they go public? What are the issues? What are the pros and cons? Maybe give us an overview, David, please.
Yeah, I would say that going public should only be done at the right stage for a company. Oftentimes I hear of young companies going public, and then when you speak to the management team, they regret it terribly. Only because going public requires you to divulge a lot of information to your competitors that you don't want to divulge. Oftentimes, young companies have proprietary information that they're trying to keep quiet, and so much so that they won't even go and get patenting, which is another topic for a different day, just so they don't divulge their trade secrets. And being a public company, that requires you to divulge information in that regard. So you want to be in a shape where you can divulge that kind of information and it won't affect you negatively in that light. Also, it plays into the way you manage your business, and it plays into the way your board of directors also manages the management team. So there's a whole bunch of negative aspects about going public. The great aspect, obviously, is if you have a great idea, a great business, you have access to great liquidity, oftentimes at a great valuation rate.
Can I just chime in there, Todd?
Please, Gord, yes.
Okay, so having been involved in many of these that started early, the other thing is they basically have a third-party board, or else they're not getting funding. And after a while, if you're the president, chairman of the company, if it's not going the right way, you've lost everything. The board just votes you out, and you're on you're on the street, and you wonder what happened. And so David and I have talked about this quite often, which is the staging of financing. In other words, just raise what you need at the time and roll it out slowly until you're totally aware and that you can roll out capital as you get it. Otherwise, you're basically devaluing your own position. The other thing I want to say, which I wanted to say before, is owner operators, especially of startups, they have a different mindset of what they're entitled to as they grow the company. They think they're going to have voting control, like 51%. And I often tell them, if you're left with 20 to 30% when you're funded right out, that's a huge amount because your company has grown a lot. So you have to get them to basically create a rational value for what their company is worth after funding. And if they don't believe that they can utilize that funding, then they shouldn't do it. So there's timing involved, and there's also the last thing, and I think you said this, but the operating people have to be competent. That's one of the first things that lenders look at, the competency of and the background of each one of the people who are either owner operators or shareholders, significant shareholders in a company. So there's a lot to go on, whether it's small business funding or large business funding, or small business funding that will get large business funding to roll out. So that's what I think.
Well, thank you, Gord. I'd like to just open a question here about the deployment of capital. In the event that, as Gord mentioned, there's difficulty with being able to utilize the funds. And Gord's comment is, if you can't use it, don't do it. I'd just like to open the, put out this question to our panel. If they have been involved with or seen situations where there's been capabilities for drawdowns or possibly an ability to deploy capital on a progressive basis. Just wonder, David or Lorne, if you've had that experience.
I can, Lorne, I'm happy to take it first stab at it. Yeah, I agree with Gord on that. Typically, in typical scenarios, you don't want to take capital that you're not going to use because it gets to be expensive. Unless you're able to defer interest payments, where some financial structures allow for that. But typically, if you don't need the capital, first of all, it'll be hard to get capital that you don't need because nobody wants to just give you money. But you don't want to be holding on to capital, I guess, to be expensive. And investors, even if it's in the form of equity, there's an expectation that you're going to use it and you're going to use it to funnel the growth of their business.
Very good, very good. David, perhaps you could talk to us a little bit about private equity, give us an idea about how the industry works and life cycles, and just sort of a overall awareness.
Sure. Typical private equity transactions are born off of the backs of private money in the form of family offices. That's where the whole business model started, where they take money, they invest it, and they lever it up. They invest it into businesses where they are expecting growth, or where they see mismanagement and they can manage it better, where they see a roll-up opportunity where they can buy several businesses of the same vein through a vertical or horizontal acquisition strategy, and then they can do a sell-off. A typical life cycle of a private equity venture is 3 to 5 years. And as of late, it's been closer to 5 than it has been 3. But because of the way the private equity firms lever their money, the returns are often very healthy.
Thank you. So we'd like to now move into the tax arena, since we're mostly tax people here. And I'd like to deal with some issues as far as expansion into various different jurisdictions. The fact is that Canada has a residency-based tax system. And individuals who reside in Canada are Canadians from a tax-paying point of view, irrespective of where companies happen to be. I'd like to just open the way right now to talk to call upon Lorne to talk about situations where host countries or countries whereby a subsidiary happens to reside, how that would be affected, and what would be an ideal situation to set up a profit center in various countries. What are the considerations, Lorne, from a tax point of view?
Sure. Okay. Let's start from an understanding of the basic Canadian international tax system. There's a very bright line that's been drawn between the Canadian government encouraging Canadians to expand abroad into active businesses versus Canadian governments discouraging Canadians from setting up passive or investment businesses outside of Canada. In the latter case, we want a level playing field. So if somebody has, let's say, an interest-bearing certificate with a bank in a domestic bank in Toronto, for example, and is paying tax at top rates around 50%, and they try to set up a foreign corporation or trust that they control, that income in that investment entity will be attributed back to Canada, either as foreign accrual property income, FAPI, for a controlled foreign corporation, or under the non-resident trust or NERT rules for offshore trusts that are funded by Canadian residents. And so we have to be very careful when we're structuring to avoid going over the line and getting into a business that is characterized as an investment business giving rise to FAPI. What we want to do is work with the existing rules. So let's say, I'll give you by analogy, let's say we have an Ontario holding company and it sets up a subsidiary in BC. And the BC corporation is liable for federal and provincial tax, and the after-tax surplus can be paid as a tax-free dividend from the British Columbia operating company to the Ontario holding company, and the Ontario holding company can reinvest that, grow the business, buy real estate, whatever. So Canada, within the context of our Canadian borders, encourages the cross-provincial transfer of capital. Let's extend that now internationally. We have roughly 100 tax treaties around the world and tax information exchange agreements. And the idea here is that we want to allow Canadian businesses to make decisions based on what's the best economic result rather than what's driving the decision from a tax point of view. So what we try to do internationally is create an analogous situation to the interprovincial arrangement I just described. So let's say there's a Canadian business that wants to set up a subsidiary in one of these tax treaty jurisdictions, and they range from high tax jurisdictions like the United States or the United Kingdom to low tax jurisdictions like Barbados. And we can talk about both of those. The ideal, again, is for the subsidiary in that tax treaty jurisdiction to produce active business income. And the definition for this purpose is very similar to the domestic definition. If one is in the business of making and selling products, providing services, and so on, those are presumptively going to be active businesses. Where we get into a gray area is with intellectual property for a number of reasons. I'll take it at the first level. If a foreign affiliate in any of these jurisdictions, even a high tax jurisdiction like the United States, has patents, trademarks, and other intellectual property, and licenses the rights out and earns licensing income, that is presumptively going to be FAPI. It's a very harsh rule, but the government has to be satisfied that that's more like an active business than it is like an investment business. And the way to do that is to meet a test of employees. If that subsidiary has more than 5, in other words, minimum 6, full-time employees outside Canada engaged in the conduct of that IP licensing business, then the income can be converted from FAPI to active business income. And that's a very important planning point when we're thinking about structuring our expansion abroad. Let's say we've got a regular active business or a deemed active business. What's the benefit of doing that? Well, if we look at, again, a high tax jurisdiction like the United States, and if the subsidiary is in a state where there's no corporate tax, such as Florida, the only tax is the American, right now, federal tax at 21%. It may go up after the election, but right now it's lower than the aggregate Canadian rate, federal and provincial. Under our international tax rules, if a US subsidiary pays its local, in this case, federal tax, the after-tax surplus we will consider to be exempt surplus, which is very beneficial. Because if that American subsidiary then pays a dividend out of exempt surplus, there will be a 5% withholding tax under the Canada-US tax treaty. The regular 30% rate is reduced to 5% on the payment of a dividend to a Canadian parent. But that's still in aggregate below 25%. And so it's now going to come into the Canadian holding company, and an exempt surplus dividend is deductible in computing taxable income. In other words, it's tax-free. So now the Canadian parent has capital that it can deploy. It can make another acquisition abroad. It can buy assets in Canada and defer any personal tax indefinitely, because it's only when the Canadian company decides to pay a dividend to the shareholders that the exempt surplus coming all the way up the chain gets taxed at the individual level. But that this gives us tremendous comparative advantage when we look at other countries around the world that don't have what's often been called a territorial tax system, as we do in Canada. The United States brought in a quasi-territorial system a couple of years ago, but there is still a potentially heavy burden on American companies, which we won't go into right now, but Canada doesn't impose a similar kind of burden on income earned abroad if it's active business income. So we want to look at the host country, the subsidiary in the host country, carrying on an active business and generating exempt surplus. We want to make sure that that subsidiary is going to be viewed from both the point of view of the host country and Canada, and under the tax treaty between Canada and that country, a resident of that country. And there are different tests, but overall the common law test that has been recognized internationally is we have to ask ourselves, where is management and control effectively exercised? So we will first look at the board of directors of the subsidiary and assume that that's where the decisions are made. And if they are, the board is comprised of, let's say in this case, a majority of American residents, and the meetings are held in the US outside Canada, then it's very likely that that company will be deemed to be resident in Canada for purposes of both of the US and Canada, and we can create our exempt surplus. If, however, the board isn't the effective mechanism for controlling the business, if the directing mind is actually coming from the founders in Canada who own the Canadian holding company, it'll be, that company will be deemed to be resident in Canada, and we cannot create exempt surplus. From a Canadian point of view, that US subsidiary will be liable to file a T2 return in Canada, and to the extent that it pays US tax, there'll be a foreign tax credit, but we do not get the same kind of benefit, yet it's still an American company. So if there's any distribution, it'll be subject to withholding tax. It can be a mess. So it has to be very carefully structured. Where is management and control effectively exercised to make sure that we're resident in that kind of country? And then just to complete the description of the options out there, I've talked about a high tax jurisdiction like the United States. Let's look at a lower tax jurisdiction, such as Barbados. And I think many people who are attending this webinar have heard us talk about how Barbados is a very useful jurisdiction in terms of asset protection and estate planning. But it's also a very useful jurisdiction from which to carry on business, as sometimes is called a stepping stone. So I'm currently in the process of advising a couple of companies, one in cannabis business and another in the high-tech business. And each one is looking to expand abroad through Barbados. And what we're in the course of doing is setting up a company in Barbados with real people, employees who are going to have the competency, expertise, and experience to be able to actually run the subsidiary. And we want to choose very carefully with the clients what are the responsibilities and duties of that Barbados company. So in one instance with the high-tech client, they're going to outsource the manufacturing of the product, but in order to do the manufacturing, there are rare earths that have to be purchased. So that Barbados company is going to have people who are charged with the responsibility of organizing the purchase of the rare earths from suppliers, generally in Asia, with the help of the Canadian founders, but not being directed by the Canadian founders. There'll be contracts negotiated and signed by the Barbados company for the purchase of the rare earths and the input into the manufacturing process, and there'll be a profit element for the Barbados company once the manufactured product is sold. Another will be, for example, with the cannabis company, there are distributors that have been solicited to who are very interested in the particular cannabis products. And so the Barbados company, in that instance, will be entering into contracts with the distributors, setting commercial terms. And again, there'll be a profit element because the Barbados company will have the people, the resources, and the competence to enter into those distributorship agreements. And then looking down the chain, we've had manufacturing, distribution, we've got sales. So the Barbados company could be charged with the responsibility of customer care, populating the Barbados company with people who can be in a call center, who have the expertise, for example, if it's high tech, to be able to remote into computers and to be able to fix problems. And Barbados happens to have a very good university, and there are many graduates with competent software engineering expertise. Now, why again Barbados? Well, many people think of it as a pure tax haven, but it's not. It's a taxable jurisdiction. The regular corporate tax rate on the first US $500,000 is 5.5%, and it goes down to 1% at taxable income at about 10 to 15 million US. So we can be creating a company in a tax benefited jurisdiction that has a tax treaty with Canada. We can create exempt surplus. We can make sure the company is resident in Barbados by ensuring that the board of directors is the entity or arrangement that has effective management and control, and with the real people to be able to satisfy any challenges later. For example, the CRA saying, oh no, that's just a shell company, there's no substance to it. No, we've got to have economic substance. Particularly in the world today, I've talked about our international tax system favoring the expansion into active business, but we also, and I won't go into the detail now, but I'd be open to questions later if this comes up. We have to be aware of a changing international tax scene promulgated by the Organization for Economic Cooperation and Development, the OECD. The countries, especially high tax jurisdictions like Germany, France, Canada, the United States, have been very concerned about the shift of profits from a high tax to a low tax jurisdiction, and a project called base erosion and profit shifting. And brought forward by the OECD is being implemented in Canada and other countries to discourage multinationals from shifting those profits by a number of tools. For purposes of this discussion, the key tool is looking at the subsidiary. Does it have economic substance? If it does not, it will be ignored. And the high tax jurisdiction will capture all the profit, saying in effect that the subsidiary is an agent for the company back in the home country. So for reasons that I've talked about, to create an active business, but to have it respected internationally, the subsidiary has to have economic substance. And without going into all the detail, the test generally is, if you want to carry on a banking business, do you have people who know banking? Do you have the resources to capitalize a bank, even a small bank in a country like Barbados? If you don't meet those kinds of very basic tests, you won't have economic substance. It will not be considered a bank by Canada. It may be considered a local bank by Barbados, but it won't meet the test necessarily back in the home country, because Canada has adopted this particular rule along with others. So when we're looking to help Canadian companies expand abroad, it's a changing scenario. We have to be aware of the basic Canadian tax rules and the opportunities to operate within the existing system very effectively, but the tests in order to create an active business have to be met. And overall, we have to be aware of, when we're doing business abroad, what does the international tax system, as well as the host country, say about what's required to make the subsidiary a properly structured taxpayer on an effective basis for the overall benefit of the group. Todd, back to you.
Lorne, I'm just going to ask. I'm going to ask a question, just because I've seen base erosion has been a big deal, even for U.S. companies, especially after Trump's U.S. tax reform. And I've seen some companies implement a limited risk distributor system where they leave some profits in certain OECD jurisdiction. Do you have any thoughts on that kind of scheme?
That's one of the things that particularly the European Union, but the OECD has picked it up as a big concern. And it's under the rubric of permanent establishment. Under the OECD tax treaties, the model that is adopted by Canada and the United States and the other countries, if a non-resident corporation such as a US company engages in business in Germany and has a limited distributorship arrangement there, conferring upon that distributor certain very limited rights, but still asserting that they want to get the benefits of not being taxed in Germany, then the Germans will look at that and say, this is not real. This is a tax avoidance scheme, and you're going to be, you American company are going to be considered carrying on business in Germany. We're going to impose corporate tax. We're going to require you to file a tax return in Germany and comply with the transfer pricing rules, which would say that the American parent and this branch in Germany with a very limited distributorship arrangement have to deal with each other as though they're dealing at arm's length, paying arm's length prices and so on, which will result in more profits being shifted to a high tax jurisdiction like Germany. So real caution with these limited distributorship arrangements, David.
Can I ask?
Thank you very much, Lorne, for that, and David. We're just going to try to stay on course, Gord.
Okay, go ahead.
So just wanted to summarize this part before we move on. And for those of you that may find some of this somewhat unfamiliar, I wanted just to take a second and define a couple of the terms. There's a common law principle of central mind and management that Lorne was referring to. And if you're looking at global expansion and you happen to be residing in Canada, well, there's a very high probability that if things aren't structured properly, the result may not be what you are intending. We've seen situations where individuals, in order to take advantage of the reduction in withholding tax by having dividends paid to exempt surplus from US into Canada, end up having companies, holding companies, Canadian holding companies, hold not only Canadian but US companies together, which presents a whole host of other problems. What we often see with hyper expansion and global expansion is a lack of the kinds of issues we're talking about. Some of the companies that we've worked with, we've helped companies in Dubai to be able to characterize their business as active business and further pay some of this exempt surplus, in other words, tax-free, from Dubai into Canada. And the term exempt surplus suggests that the income had been subjected to the tax in the local jurisdiction and then provides for payment into Canada without any tax notwithstanding withholding tax. So what we're getting at here is there's several parts to this, this issue that we've been talking about. We started talking about companies that are interested in global expansion and financing opportunities. So the Quantum Tax Law Consortium has assembled a division which is very happy to help any one of the companies in attendance who is considering this kind of expansion, who is looking for financing where it may not be available through conventional sources, whereby bond offerings can be used to generate large amounts. We've been involved with amounts ranging from 50 to 500 million as far as helping companies to acquire financing where there's a big upside, big potential for this kind of growth. And then, of course, you've kind of seen for yourselves the kind of advice that we can provide as far as helping companies to position themselves for expansion. There's a lot to it. To go through blindly and say, we'll open up in these various countries because we have a great product isn't enough. There's so many considerations and above all, so many errors that get made. And that pretty much concludes this part. Gord, if you have a brief comment to make on this part, fine, then we're moving on because we have a large agenda ahead of us.
Okay, I just wanted to ask Lorne one question, but Lorne doesn't seem to be there. So
Oh,
there you are. There you are.
Just briefly, Gord.
Very, very briefly. So what would you say to somebody who's a Canadian active company, but does all its business in the United States and elsewhere? What would you suggest for them?
Well, thinking about setting up a subsidiary that does their global business, populating that subsidiary with competent people who are resident in a local jurisdiction. Barbados again comes to mind if it makes sense for the Canadian company.
Okay, okay.
Thank you. So we'll move on to talk about exit strategies and whether it be that it's your intention to sell your company. Certainly the consortium has solutions that they could offer to you to assist in that regard. If you're considering succession and passing the business on to the next generation, there's very critical issues that have to be looked at. If it's an IPO, you're looking to go public, a lot of considerations. What we find most often is companies, when they come to us, they already have a buyer at the door, and sometimes it's too late. So what I'm getting at is that if you have a business that you're considering selling, as an example, and you've accumulated a significant amount of surplus cash or investments inside of your active business, or perhaps inside of a holding company, oftentimes individuals in that situation have not received advice that it isn't good to accumulate cash in the form of retained earnings, surplus cash that's building up inside of a company, whether it be a holding company or whether it be an active business. There's asset protection issues. Canada, in the past program, we've talked about the fact that Canada has the Fraudulent Conveyances Act, which purposes to be able to pierce a corporate veil in certain situations. The money that you've moved up into your holding company may not be so safe after all, even when you have a trust in Canada. And for that reason, it's very important in our view to look at how you can remove surplus cash or investments from either an operating company or holding company through what we call a conduit. Do you have a conduit for your company that allows you to be able to move cash out of your active business or your holding company without tax to a company that you'd never sell? I'm not suggesting at this minute that you're going to be accessing the funds personally in this situation. But what it does is it helps you to avoid paying an enormous amount of tax. I recently had a client who had come to my office and asked me about doing tax planning. I demonstrated how he could remove millions of dollars out of his company and prepare for a sale. Selling a company is a process. It's not something that you wake up one morning and say, I'm going to sell my company today. Number one, it takes time to find the right buyer. Number two, it can take 2 to 3 years to create the right structure that is suitable and compatible with your goals, with your objectives of your family, of the business, your employees. There's many considerations. Today's conversation has only skimmed the surface of some of the issues that you really need to be aware of. If you're looking for an exit strategy, you're looking to be able to arrange your affairs so that shareholders receive the maximum amount and tax can be mitigated. So there's no point in selling a company with $10 million of cash and saying, I'm not going to have to pay the tax. Well, the dividend has to be paid if it's done prior to a buyer being at your door. There are certain tax planning strategies that do not allow for execution in contemplation of a sale. And this particular client was a little bit annoyed with me, and he said, so you're afraid to do it then? And I said, the only thing I'm afraid of is you being harmed. And that's why I'm not going to do it. He could have moved millions of dollars out of his company and avoided the need to pay this huge amount. So that's one issue. Now, before we go further, I'd like to call on David for a minute to talk to us about possibly what I would call the silver lining in the COVID-19 cloud. We realize that upon death, our shares of our company are deemed to be disposed of, as is other capital property, for purposes of paying capital gains and paying capital gains taxes and computing capital gains taxes. And oftentimes, people that we work with are not aware of the fact that if we're able to reduce the value of the shares they hold in their hand, then the tax later on would be less. The most expensive thing to do is to do nothing whatsoever, because then what happens is all of the value continues to grow in your hands and does nothing to serve purposes of tax reduction, does nothing to serve purposes for asset protection. So if we can do a valuation on a company and determine that the value is lower on account of the economic crisis, you could save millions of dollars. David, I'd like you to comment on the perceived differences that we'd see today versus, say, a year ago for some companies that are affected in an uncertain fashion on account of the COVID-19 crisis.
Funny, throughout the year, things have changed. So at the height of COVID, I would say there was lots of uncertainty in the air, and we saw premiums being added to discount rates where the risk factors were I'm going to say largely impacted, or bigly, to quote our president of the South, impacted. Whereas as the summer has progressed, we saw some of that risk go away. Businesses started to be open and active again, and a lot of business came back online. Certain industries still have downside risk. Other industries have upside risk. And it's part of the chaos that's caused by COVID. Overall, though, I wouldn't be opposed to, as a CBB and an evaluator by trade, I wouldn't be opposed to putting some kind of a premium, risk premium on companies, on all companies really, just given this type of environment. It's just a riskier macro environment that we're facing.
Yeah, so the thing with it is that eventually, as things return to normal, I'm saying that on the eve of a second wave, um, then eventually this opportunity would close. So for those of you who have done estate freezes, who believe you've done what has to be done, this is a call to think that over again. Because as David's mentioned, the terrain has changed, the climate has changed. And to the extent that there could be perceived values that are lower, there may be an opportunity to take a company that you froze at 5 or 10 million and then consider refreezing it at a much lower level, putting millions of dollars of tax back into your family as far dollars that would have otherwise been paid in tax. There's many, many different ways of doing this. At this point, I think I'd like to call on Jeremy to display our slides, please. And what we're going to do is we're going to talk about various different issues. And as we do, I'll call on Gord Berger to comment on what happens to an active, successful business that doesn't have the hasn't taken into an account various different issues. Gord, in your experience, have you often run into companies that have various shareholders that don't have shareholder agreements?
Probably most of them, or they're outdated, or they're never done, or people think they actually have done them, but they haven't signed them. We find this all the time, and it's actually very troubling because these people work very hard. They've had good partnerships, but they don't realize, as Todd and I were on a call this week from a potential, well, a prospect out west, a big one. And there were two brothers running a second generation company. And they had done everything that their lawyers and accountants had told them, but they forgot to do one thing, or nobody counseled them to do one thing. And the one thing was, the most important thing was, they didn't have an agreement between them, because now they were the newco. They were, after the freeze, they were partners or shareholders. They didn't have a partnership agreement, and I had to bring to light the fact that although these two brothers are very close, that when one of them died, if they hadn't made provision, and all of you watching know what I'm going to say, that the one brother would now be in business with the other brother's wife, who it became very clear that neither one of them wanted to have that. So things like that have never, and they had no funding arrangement, so they had no way of actually figuring out how to get the shares back, either for cancellation in a corporation, depending on how the structure is done, or on a crisscross outside the corporation. Nothing, no value had been given to the actual problem. So there are many things like this, but just to go on, if I could, just before you get into this, the other thing that Todd and I found is there are opportunities out there. We're working with different people who have spent years and years coming up with things that are actually compliant, as we do, and they're unique and they don't get around for whatever reason. So one is, Todd was speaking about if you have too much cash in your corporation. So we know companies, for instance, one out west that we're dealing with right now has $38 million of cash in this corporation, and most of it is passive. It's not active. It's not within the 90% rule. And so there are, of course, things that Todd can do, but there are things that we can do, which is we can get the money out into somebody's hands, actually at a very low tax rate, not into the corporation, even if the asset's owned in the corporation, but right into their hands. And for a net cost of maybe 10%, and the tax cost would be obviously higher than that. It could be 25 or 13. So there are all kinds of things that we can do. And if you've watched before, you know that we have the capability of a strategy that I created many years ago of being able to take money out of a corporation compliantly without any personal tax whatsoever. So there are many things that Todd and I and Quantum and the respective partners and associates can do. But for the first call is from you to us to help you, because otherwise we're trying to disseminate this ability to do these things. So it's up to you, but they're all unique. well thought through, compliant, and like I say, bespoke. Todd.
Thank you, Gord. So we're just going to talk about a simple situation. And we mentioned complicated structures. Well, this structure on the screen isn't complicated, but we see this often. We see situations where very little concern is given to the type of assets that accumulate inside of an operating company. And then we often see situations where we have stacked companies, in other words, a holding company on top of the operating company, and mistaken belief that it's just fine to pay large dividends from the operating company to the holding company. There's a lot of very punitive effects of not being careful. One of them is paying very high dividends from an operating company to a holding company, which can result in unexpected taxation, where a dividend gets converted into a capital gain, a pitfall that you don't want to fall into. Then we have situations where companies that haven't done estate freezes simply have shares of an operating company held by a holding company, accumulating a lot of real estate, mutual funds, even cash can cause the loss of capital gains exemptions. So we often see that. We see situations where there can be 30 or more companies with absolutely no thought to tax planning that's been put into this whole event. So what we often do is we say, well, we could assist by creating a conduit. And what do I mean by a conduit? Well, in the situation of an estate freeze, we have the same operating company, and essentially we exchange shares under a section of the Income Tax Act that causes and has the effect of any capital gain to be deferred. That means that the entrepreneur has common shares that are worth, say, $5 million. He essentially would exchange the $5 million of common shares for $5 million of preferred shares or frozen shares. And the preferred shares never change in value. They have a stated value. On contrast, the common shares grow in value. That constitutes an estate freeze. At that point, we can then create a conduit. We can issue common shares to a trust that didn't exist previously, and we could use that for a different purpose, and for one purpose, and rather we would set up an investment company, or sometimes we refer to as a capital company, and we have a separate class of shares. Say Class A shares are held by the trust, meaning all of the future value that is over 5 million. And if we can freeze lower than 5 million, as I mentioned before, we'd like to. And the future value would all go to a trust, whereby the beneficiaries would be family members. And there'd be a capability to multiply the capital gains exemption. The class of shares that are issued to the investment company are common Class B shares that are created for one purpose, and that would be to act as a conduit to carry dividends. In other words, to pay dividends on the shares in order to move the money out of that company. Keep in mind that the intent here is for the investment company never to be sold. I'm going to hitchhike on one of the comments that Lorne made with reference to central minded management. In this case, we cause the investment company to be controlled by a foreign trust. And that means we have very superior asset protection. And effectively, what we've done is we've created a dichotomy, a division. We've created a separation of assets. Inactive assets, the investment company, and the active assets can remain in the active business for the time being. What that means is that there's no loss of capital gains exemption on account of mutual funds, real estate, other things that is not occupied by the business. Oftentimes we see situations where condos and cottages and all sorts of things are stuck inside of companies they should not be stuck inside of. There is a capability through a series of transactions, to move assets sideways from the operating company to the investment company in a fashion that you will not be affected by the anti-avoidance rules that can cause a dividend to become taxable as a capital gain. And essentially, we call that a butterfly transaction. And through a series of transactions, we're able to move assets. Oftentimes, we have calls from accountants and lawyers that say, well, we wanted to do that butterfly transaction you talked about. Oh, what about the land transfer tax? Well, in reality, there's a provision in the Land Transfer Act that allows us to be able to move assets where companies are affiliated, such as you could see on the screen. in a way that it wouldn't mean that you'd have to pay capital gains taxes. And that way we can purify the company. Of course, this is a very simplified version. And if you're a company who's expanding, you're a company who wants to preserve its wealth, there's so many things that you can do. And the type of advice that we're giving, I did a lecture a while back at the Ontario Bar Association for a group of lawyers on this and other subjects. And one of the things that I noticed is that there seems to be a propensity for professionals to conduct themselves in silos. The accountants are here, the estate lawyers are here, the corporate lawyers are here. Some of the things that we're talking about today do not fit in any of those three silos. And that is essentially why we exist. So when we're talking about this additional benefit, whether you're an accountant, a lawyer, or happen to be an entrepreneur, there's issues here that are not commonly addressed that we can help with, and we'd be delighted to make ourselves available. I'm going to extend this a little bit further and call on Gord Berger, and he's going to talk to you about how he's been able to use insurance. Now, before we do that, I'll say that insurance has an almost sacred status in the Income Tax Act. No death benefit on life insurance. There's no annual accrual taxation on the accumulation of funds within cash within a life insurance policy. There's really no annual tax at all that has to be paid. And using the same structure whereby you're buying insurance, in this case, you're buying what appears to be a large policy, and I'll have Gord explain that, but the money is being paid with after-tax corporate dollars that may be, say, 87.5% dollars instead of, say, 47% dollars if you were at a 53% tax bracket. So, Gord, we've created the structure. We have set up a trust. We've created asset protection. We've multiplied the capital gains exemption. We've purified. We've done everything that we could see doing. And how does your concept work in harmony with this? Maybe you could help us to understand.
Sure. So many of you heard this before, but just to go over it. So once we get to actually Invesco, where a lot of the money is, so the top tax rate has been frozen at 26.5. But there is a problem. A lot of that money, and for people who do this, family offices and so on say, well, this money's forever. But some people would like to take some out on an annual basis. And so it becomes very costly to do that if you don't have an alternative strategy. Because even when you take money out, you pay 26.5% in the corporation, but there's no federal refundable tax. So when you take money out by way of a dividend, what happens is you're going to end up paying the 26.5 plus another 36, 38%, depending on what province and so on you're at. So it becomes really hurtful to take it out because it's over 60%. So the solution is actually simple from a 32,000 foot altitude. And what we do is we basically, given that the shareholder is insurable and probably under 65, it can be done over 65. It just becomes less efficient, but still better than doing nothing. But under 65, what we do is we insure the shareholder or shareholders in the corporation, so in the Invesco. And let's say they want to take out, just for fun, $2 million a year. So what we do is we apply for policies which cumulatively are $2 million of annual premium from, let's say, a pot of 30, 40, $50 million or less. And we insure that. So the $2 million of premium would probably create about another 50 million of life insurance in that corporation and a lot of cash. So we have Canadian banks who will lend on the cash surrender value of the policy in the corporation. And as Todd said, the premium, just to go back, the premium is paid in after-tax surplus or retained earnings. So it's not really coming out of anybody's pocket, it would have stayed there. We can get it back though. So we have Canadian banks like Scotia. I do a lot of work with Scotia, but not only. And I have a deal with them whereby they'll lend on the cash value in the corporation using the cash value as collateral at bank prime or less. They go down to banker's acceptance plus 140, which today, so bank prime's 2.45 today, so it'd be under 2%. And of course, interest rates are variable, but we actually demonstrate that in our disclosure document. So you're going to lend, if you put in $2 million in premium, the loan is going to be between $1,950,000 and $2 million, depending on age and so on and circumstance. We're going to lend you that money personally or corporately. Most people would like to get it in their own personal bank account because you're not paying tax. It's just being funded by a loan. And the loan, just again, I want to outline or underline the fact that the loan is purely collateralized by the cash in the contract. So in the downside, if something ever happened, the bank really has only access to the cash in the contract because they will never lend you more. So you're fully covered, fully secure. So now you have the money in your in your hot little hands if you want. And under 3 sections of the Act, we've resolved and we're compliant in the fact that we say if you pay a guarantee fee from the loan amount, from the, call it $2 million, to your corporation, and we use as an indicator 1%, it could be half, it could be 2, but if you had the ability to borrow the money anyway at bank prime or less, then there's really no taxable benefit that Revenue Canada could claim. But nevertheless, we say you pay at least a half to 1%. So 1% of 2 million is $20,000. We also subscribe to the fact that because you're not paying tax, even though it's compliant, you don't write off either the guarantee fee nor the interest. Because what you're going to end up with is you would have paid on $2 million. And I think everybody agrees, if you took $2 million out of a corporation, especially if it's in the Invesco, you're going to end up paying $1.2 million of tax at, call it 60% cumulatively. And this way you're not paying any tax. So you're going to have a lot of tax savings. We will be able to give you what you would have taken out on an after-tax basis, and you'll have the tax, and we suggest you reinvest that either back in the corporation as a shareholder's loan, and we secure it with a PPSA. So if there's no bank debt in your corporation, your shareholder's loan is first in line. And if there is bank, the bank always comes first, you'll come second before all of the creditors, which are unsecured. So we've been doing this for years and years. It's totally compliant, as I've said. We sort of dot all the I's, cross all the T's, and our diligence package is, I would say, the best diligence package in Canada. And we love working with you as accountants or lawyers because it allows us to spread the word and help your clients. So if you have any questions, you can get back to Quantum. They'll introduce you to myself or to Todd, and we can go from there. How's that, Todd?
Thank you, Gord. Lorne, I'd like to ask you to comment on some of the differences in our Barbados trust to a domestic trust here in Canada.
Sure. Typically, we see in a domestic estate freeze that a trust, let's say, is established in Ontario, typically, let's say, a husband and wife and a friendly stranger. I call the outside person would be the 3 trustees, and they make decisions on a majority basis for the benefit of the family members. And there are at least 2 defects that I identify with that kind of typical arrangement. First is the asset protection that kind of trust provides is weak, and the tax results for income earned within the corporations owned by the trust is very high. So let's talk about the asset protection for a moment. In Ontario and right across Canada, we've inherited a law from England. Here it's called the Fraudulent Conveyances Act. And the import of it is that if a person transfers assets to a family member or to a trust for family, and the purpose is viewed as being to hinder, delay, or defraud in a civil, not a criminal sense, creditors, it can be set aside and a court can order that the assets be brought back into the estate of the debtor for the purpose of the creditors. Now you would think, well, why does that really apply in a typical estate freeze? And here's the reason. The Supreme Court of Canada made a decision a number of years ago consistent with the legislation dating way back to what's called the Statute of Elizabeth in England. But it comes as a surprise to many who haven't given, I would suggest, proper thought. An individual wanted to set up a tavern in Ottawa. He put his money into it, began the business, and for the first while was doing well. But then as the business faltered, he got nervous and he transferred his assets to his wife for quote unquote asset protection. Of course, the business failed. The creditors sued and the case went all the way up to the Supreme Court of Canada. And what the judges said there was, yes, the individual did offend the Fraudulent Conveyances Act because he prejudiced not only the current creditors, but they went on to say he ought reasonably to consider who future creditors might be that would be prejudiced with respect to the transfer. And how do we know with an Ontario trust who a future creditor might be? It could be somebody from business, an outside creditor, or more to the point, it could be somebody inside. An entrepreneur's daughter marries badly, and the son-in-law, as part of a lawsuit, sues. And it's all here in Ontario, and the son-in-law makes the argument that he's somebody who ought to have been reasonably considered, and he wants a piece of the family assets. So that's the first really deficient arrangement that a typical Ontario trust has. To contrast that, a Barbados trust is different. We are still setting up in a typical way a gift from the contributor or settlor, not the entrepreneur himself, but a settlor making a gift. In this case, it's to a licensed corporate trustee in Barbados that we've worked with for years and are very comfortable with. Former Royal Bank of Canada employees head up that company. And that company, under a deed of trust, will be appointed as the trustee to manage the assets for the benefit of the discretionary beneficiaries. In other words, the family members are listed as beneficiaries, but none of them has a fixed entitlement. They all have contingent interests because it's up to the trustee to decide who gets what assets, when, and how much, not in a way that is arbitrary, but in consultation with the family, and we can get into that later.
Lorne, I think we have a question. I'm going to call on David to ask a question to the panelists, and we'll come back given sufficient time. David, are you there? David, I think you've muted. You're not David Ayanoglou.
Yeah.
We have a David in the audience who's put up his hand.
Oh, sure.
Okay, we'll move on to Albert. Albert's raised his hand. Albert, are you there? It seems like we're having the technical. We have a number of people who have put their hands up and asked to ask questions, and regrettably somehow I'm not able to ask them. There is a question though that I noticed came from Justin. Justin's asking what type of insurance policy would create that level of CSV in proportion to the premium. So Gord, I guess Justin is looking at your illustration and noting that you're borrowing almost what you're putting in. And it seems like he's asking the question, how are you coming up with the kind of cash surrender value that would serve as collateral? What's your answer, Gord?
Okay, so we've created a unique funding situation whereby we actually have two lenders. One would be a top 7 or 6 bank here, and another is an alternate lender who, under the same conditions, interest rates, commitments, security, would lend up to 100% of the premium, not the cash value.
So
It's really the magic sauce of what we do. In the marketplace, you can find some people in our business that would lend up to half, but really it's 90% of the cash value in the first year on $1 million premium. The cash value would be about $500,000. So they'd lend about 450,000. So you'd be out 500,000. That's not very, that's not something that people want to do. So we created another suggestion by finding another lender who's happy to take the spread. Just as Todd was saying, in Europe, for instance, you know that people are buying bonds at negative yields, so it's pretty easy to do that. Our interest rates has gone from 2.95% to 2.45 recently, and it'll probably even go down more.
Okay, so I guess we're coming close. Okay, so we've got Ken Wright, who's come back to us and has raised his hand. Jeremy, I don't know if you can activate Ken on your side. I can't seem to do so.
While he's doing that, let me just respond to that last point, the distinction between Ontario and Barbados, because I think it's important. In Barbados, there is no Fraudulent Conveyances Act. There is a statute that says you can't commit fraud, but you only have to look at the current creditors, not who reasonably might be expected to be a future creditor. That's the first thing that's very important. And the second is they have a limitation period. After 3 years, after the trust is set up, a Barbados court will not entertain a claim to challenge the validity of the trust. So that's the second very important asset protection element. Back to you, Todd.
Oh, thank you very much for that very comprehensive explanation, Lorne. We really appreciate that. I think that what we'd like the audience to take home with them, if you will, is that we're talking about a traditional estate freeze using a foreign trust. No money is sent to Barbados. There's no corporations in Barbados. The trust in Barbados has only one function, and that is to hold shares of a company back here in Canada. So this requires much more explanation. I noticed that there was another question respecting the kinds of financing, and the asker of that question, you're welcome to send us an email or reach out to us, because we have a policy never to go beyond the cutoff point, and I think we have another minute to go. We'll conclude the program by saying that we genuinely appreciate the support of all 70 odd people in attendance today. We have found that the feedback from our program is important. It's what keeps us doing this. We've often had weekly programs, and sometimes we've skipped 2 or 3 weeks at a time, only to have people calling us and making suggestions and telling us what they'd like to hear in the upcoming program. That being said, the Quantum Business Law Consortium would like to remind you of 2 very useful services. One of them is Tax Assist, which means we provide complimentary initial tax advice on practically any tax matter. We also have Litigation Assist, where we can talk to you about litigation issues. In addition to that, we also invite any companies in attendance who are seeking to achieve global expansion to contact us, because we certainly have much to offer as far as guidance, not only in how you can position yourself in order to be the recipient of some of this funding, but also what you should be doing in order to properly structure yourself so that you don't end up in a chaotic situation like many people do, where they set up companies with a certain intention, their intentions aren't fulfilled because of the very important tax ramifications that need to be considered. That being said, we're coming up to the bottom of the 2 o'clock bottom of the hour here, 2:30. And we'd like to apologize for those of you who were attempting to ask questions, but please reach out to us and we'd be happy to answer all your questions. That being said, we'd like to wish you all a very pleasant day. Thank you for joining us. Thank you to our panelists as well, who did an incredible job of providing insight on all these subjects.